If I could just introduce the moderator of this next session, it is John Authers from the Financial Times. John, we're delighted to have you here. Thank you very much, and over to you.
Mary, thank you very much indeed for that introduction. Can everybody hear me well? Good, good. I'd first of all like to say a very brief personal thank you to the organisers for inviting me to do this today. It's partly because this is my alma mater, and I'm always only too happy for an excuse to come back to Oxford for today. But also, those of you who have been gratified to see a few copies of the FT floating around in the audience. Those of you who read the FT regularly and are particularly eagle-eyed will have noticed that I haven't actually written anything in the FT since September. That's, I regret to say, because I've been in and out of hospital since then, and I'm delighted that I'm now decisively getting better. This is my first return to the public arena as John Authers of the FT in some months, and I'm extremely happy to have been given the opportunity to do that. Also, after spending a little time in hospital, it's wonderful how finance begins to be seen in a different and perhaps proper context. Now, we have a quite remarkably high-powered panel here to discuss one of the critical, possibly the critical issue for the global financial system arising out of the implosion that followed the collapse of Lehman Brothers in 2008. We need to discuss regulation, or perhaps more precisely, the re-regulation that apparently was evidently necessary after the wholesale failures that were revealed 4 years ago. Perhaps to try to start off the debate, I think I'd like to posit the view, which is very widely spread, that what should have been the great re-regulation has in fact begun to turn into the great escape, at least as far as the banks are concerned. Now, that's certainly a widespread perception. That certainly creates obvious political problems. What we need to find out is whether this creates systemic issues, risks for the future in the financial system, and we also need to work out how the banks have dodged the bullet, if indeed they have. I think one final point I'd like to make before we start going over to the panel is to frame this in terms of the concept of moral hazard. The notion that if somebody is there to bail you out from the downsides, from the consequences of your risks, you're more likely to take irresponsible risks in the first place. Normally, a great financial crisis, the epoch-making variety that we saw in 2008, would solve the moral hazard problem for a generation. People would lose their money, some financiers would go to jail, banks would go bust. The sense of moral hazard would be gone for a while. It is certainly arguable that that hasn't happened this time. Big banks are intact, and virtually nobody has actually gone to jail. Very different from the 1930s. Now, to frame, again, this is an argument that has been going on at least since the 1990s. There is a very difficult dilemma or a duality that has to be confronted when we re-regulate the banking system. And it came up most perfectly for me in 1998, back when I was reporting on banks in New York. Citicorp, as it was then called, had just agreed to merge with Travelers, creating this vast new bank that was going to sprawl across many different financial businesses. And Henry Kaufman, who had previously been known as Dr. Doom on Wall Street, a very well-known economist, annoyed quite a lot of people by making a speech where he pointed out that this new entity was plainly far too big to ever be allowed to fail. The consequences would self-evidently be disastrous. He therefore posited that there were only two alternatives. One was to force such big banks to split up. The other was to take any banks that were too big to fail and regulate them until the pips squeaked. I don't know, it's possible to argue with that duality, but that debate continues throughout all of the discussions that we've had post-Lehman. So that's how I would like to ask our panelists to start their remarks. What is it that we need to do in terms of re-regulating the banks that we have not yet done? And I would like to start. Their CVs are all in your packs there. This is a quite remarkable collection of individuals to discuss this. I'd like to start with Sir John Vickers on my right, who has grappled, particularly in the UK context, with this perhaps more than anybody else.
Right, I didn't know I was going first. Am I audible as well? So your general question, John, is whether this is turning into the Great Escape. I would say there is possibly, but there is still, in my view, all to play for. And the way I would want to approach this is got to distinguish between what's going on at national level in various places, including the UK, which is obviously what I know best, and on the other hand, what's going on at international level, where, I mean, Adair and Philipp have been intimately involved at various stages of that. And of course, the two relate very much one to another, given some of the geographic arbitrage issues. Now, an interesting in-between domain, which I will say a bit about, is the EU debate, which in the last few weeks, with the publication of the Liikanen report, which some of you, but I guess not most of you here, will be familiar with, I think that debate is entering a new phase, and in particular it's starting to look at the structural issues. Before I get on to structural questions, though, I think the one huge thing that we learned from the crisis was is about loss absorbency, where you have the following two facts in combination. These banks were, which in the case of the UK banks, had been chugging along for decades with leverage, that's balance sheet in relation to equity capital ratio of about 20, that sort of region. In the run-up to the crisis, and it happened in a pretty short space of time, within a decade, that doubled or more in the case of a lot of banks. And to people who say, the crisis has taught that we need completely new economics, well, maybe we do, but you don't need any new economics to tell you that 40 times leverage is an accident waiting to happen. You don't need a big shock for that to be putting lots of banks underwater. And if I had to make a point in favor of the hypothesis that this is becoming the Great Escape, it would be that the international debate on leverage caps, which still hasn't got a settled agreement, is aiming to have a cap of 33 times. That's the new sunlit uplands, not yet attained. Now, a lot of banks have done a lot of deleveraging, partly out because of market forces. But if you step back, I think this is a very, very strange way to run market capitalism, that these institutions, which are so integral to it, have run, will continue to run on such a highly levered basis. The second and linked fact is that when events really hit 4 years ago, that you might think, well, in theory, the debt bondholders should bear some of the pain. But it's just astonishing how they generally came out whole, even unsecured providers of debt finance. I'm not speaking of depositors, but longer-term debt. And why did that happen? It happened because the place they lose money is called bankruptcy, or was called bankruptcy, and governments couldn't let these entities enter that state. So the international reform agenda to have higher capital requirements, better quality capital, less fragile risk weights, coupled with all the efforts to increase the chance that bondholders can lose money, that is a really, really important debate. And the debt finance bit of that, the bail-in debate at international level with the FSB, at European level with the draft directive in that area, I think that is fantastically important. And to create non-bankruptcy regimes, these so-called resolution regimes, where you have not just the equity layer of loss absorption, but the bond layer as well, I think matters hugely. And linked to that, are questions like depositor preference, and we could get into all sorts of technical issues. Why does that matter? It's partly to have a bigger private sector loss absorber in the future. It's also to get market incentives to discipline risk-taking to get back into play. You spoke, John, about the too big to fail and implicitly about taxpayers being on the hook, which they are more than pre-crisis because of what has happened. And that loss absorbency piece is absolutely vital. But let me just say a few words before handing over to others on the structural question. I chaired the Independent Commission on Banking, which ran from mid-2010 to the autumn of 2011, making recommendations to the UK government, which largely they are proposing to implement, and there is now draft legislation. We said a lot about competition, not just financial stability, and what we said about financial stability was as much about the loss absorbency issues I've touched on as about structure. But we're best known for the structural recommendation, which goes under the name of ring fencing, which is the idea that if you've got a big, a universal bank, I mean, you spoke about, Citigroup is big, but in relation to its economy, it's small compared with Royal Bank of Scotland or Barclays or others, each of which have balance sheets approximately the same size as a year's output in the UK. So ring fencing is the idea that you put a fence, we can discuss how you design it, around core retail services, those which households and SMEs absolutely rely on, have no alternative to. And there are activities like trading, market making, lending to other kinds of financial institution, non-European things which can't sit in that legal entity, but the legal entity can sit within a wider banking group. And I don't think the UK banks will escape, to use your word, from that. I think the government is going to do it. There are questions, though, about the design of the fence and the strength of the fence where I think the debate is still to be had. And the government here has pulled back a bit on some of our recommendations, but I would say they're fundamentally intact. And I do think that that is all to play for. Now, finally, on Liikanen, in almost exactly a year ago, when he was appearing before the European Parliament, Commissioner Barnier, who's the Single Market Commissioner, he said he would set up a group to look at the structural question for Europe as a whole. And the cynics thought that this would be a grand group that would conclude that nothing ought to happen. When the governor of the Bank of Finland, Erkki Liikanen, was appointed to chair that group, I think the cynical view was challenged because he just isn't that type of individual. And indeed, they have come forward with proposals published 2 months ago, which are now in the sort of European machine being debated for, they call it trading separation. So we had if you like, a fence around retail. On their proposal, you separate off trading. And as Martin Taylor, who's an ICB colleague of mine, put it, that by itself is a distinction without a difference, because just as a fence around, think of Magdalen College, a fence around the deer park to keep the lions away from the deer is the same as a fence to keep, a fence to protect the deer is the same as a fence to keep the lions away from the deer. Now, there are some differences between the UK proposals and Liikanen, but fundamentally I think they're very much in the same place. They're both different from our mutual cousin, the Volcker rule in the US, which I think is too detailed an issue to get in opening remarks, but if there's an opportunity later, I'd be very, very happy to talk about how these different things do or don't relate. But I think something structural is going to happen in the UK. The full splitters would go further. We can argue whether they're right or wrong. I think that is going to happen. In Europe, I think it's very possible that something will happen, which people wouldn't have been betting on more than a year ago. More widely, I do think these Basel and FSB debates around bail-in are incredibly important. The whole resolution debate, cross-border resolution. But my answer to your meta question, John, would be we'll see.
Okay. We're never allowed to end a column with time will tell, very, very sadly, even though it's always true. Next, I'd like to call on Philipp Hildebrand, who when he was running the Swiss National Bank, had the experience of regulating two banks, which both must have been very much bigger than the GDP of Switzerland in UBS and
peak about 450% each.
Right.
So.
Could you take us through how you went about that challenge and whether you would agree that that those banks in particular, or banks in general, have enjoyed a great escape.
Sure. Thank you very much, Sean, and it's good to have you back at the FT. By the way, today's the FT is particularly worth reading in this context. On the front page, the article about Deutsche Bank, and what I found striking, not surprising but striking, and John mentioned it, is that even today, the leverage of Deutsche Bank, the sunlit uplands, what did you call it?
Yes.
I think is mentioned to be 2-point-something%. So even after all we've done, basically we still have a leverage in this particular case that is in excess of 33 times. So that tells you a little bit about the leverage ratio, and I'll come back to it in a second. But what I thought, just in a few minutes, what I'd like to do is three things. First, just to go back and recall what the objectives were of the regulatory reform agenda that emerged fairly spontaneously and very early with something called at the time the Financial Stability Forum Working Group on Resilience or something, right, Adair? I think that's what it was called. It later turned into the steering committee of the Financial Stability Board. The second thing, very briefly, and I can closely follow John on that, to say, you know, what do we see now? What has come out of this? Is it true that we're in the Great Escape or not? Like John, I think it's much more subtle than that. And then just 2-3 sentences on, as we begin to look back at this period, and that's a fairly personal comment, you know, where did things go wrong to the extent that they did go wrong? So let me start with the first point. It's in essence very simple. The regulatory reform in all its complexity, in my mind, tried to address three things and had essentially three objectives. The first one was to say that out of the realization that the equity layer in these banks was far too small. And if you read again the front page article today, it's very nice. Or there's an editorial in the back pages too, which describes it very nicely, that it takes a minimal move in prices on your assets to wipe out the entire equity base. And so the very first objective was to say, you know, we will always have crises. We will not be able to eliminate crises, nor would we want to do that, frankly, in a market economy. So therefore, what needs to happen, the shock absorbers in these systemically relevant banks need to be much larger, and that's a different way of saying they need to have much more capital. So that was the first objective of everything that later followed on the reform agenda. The second objective, in my mind, was to say we will likely not be able to get to a point where the shock absorbers are so large that the probability of a failure at some point in the future becomes effectively negligible. And so therefore, in the event that even with the new shock absorbers, we do not have enough loss absorption capacity, we need to have a mechanism or a system, a framework by which we can, in an orderly way, wind these banks down. In other words, allow the very essence of a market economy, allow bankruptcy to function, to occur, and avoid a situation where you're in this, as Henry Kaufman said, when was that article? 20 years ago?
98. Yeah,
98, 15 years ago, where you have no choice but to say, we have to bail them out, no matter what happens, no matter how big they are. So that was the second objective. The third objective of the way I see it, of the whole reform agenda, was to say, we also need to make sure that we can create as level a playing field as possible, since this is a global problem and ultimately not a national problem. And that was the very essence, by the way, of the origin of the Financial Stability Board, to essentially try to create a body that would watch over, you know, a hopefully level playing field. Mario Draghi, the then chairman of the FSB, now the president of the ECB, had always insisted on that in every press conference throughout the reform process of Basel III, that we should never forget that all of this was meant to create as leveled a playing field as possible. So if you take these three objectives as given, and maybe others see other ones, but to me they were really what drove the reform agenda, then we can now ask ourselves, where do we stand today? Or where are we likely to stand over the next 2 years? And I would say, contrary to the sort of great escape theory, in reality, there's been a lot that's been done on capital, perhaps more meaningfully on the definition of capital than on the level of capital. We have effectively eliminated all kinds of capital that frankly was not loss absorbing, but was allowed to be counted as capital. In fact, and it's mentioned today as well in the FT in the case of Deutsche Bank, it was very much true in the case of UBS. By the reigning capital standards, UBS was the best capitalized bank in the world at a time when, in terms of pure leverage, it was one of the worst capitalized banks in the world. And that tells you in a very simple way that we had a huge definitional problem of what constitutes capital. So I think a big piece of Basel III is a tightening up, significant tightening up of the definition of what counts as capital. In terms of levels, again, levels have increased significantly. Although mostly on the risk-weighted basis, so where we have made relatively little progress is on the leverage ratio. To me, more troubling on the leverage ratio is that, in fact, today, the leverage ratio continues to be something that, frankly, from the outside, you cannot calculate and you really cannot determine. None of us, if we look at a balance sheet or an annual report, can really determine what the leverage ratio, according to Basel III, is looking at it from the outside. So I think we continue to have very significant definitional problems on the leverage ratio. So there, frankly, and the FT says it today, much less progress has been made than we might want to think or hope on the leverage ratio. On the resolution side, we sort of put in place basic frameworks, basic standards. On the other hand, I would argue that if tomorrow one of these large international banks fails or is at the point of failure, it is not clear to me that we are operationally in a much better position than we were the night of Lehman Brothers. So I would say that's clearly an area where we have not achieved enough. And that's the whole question of bail-in. We'll come back to that in the discussion. On the playing field, the level playing field, that's perhaps the most difficult area. As you all know, even if you read this in a superficial way, as at the national level we went into implementation, things really started going off in all kinds of different directions. And it is pretty difficult to argue today that we have successfully accomplished the mission of creating a level playing field. When I look at all these national initiatives that are either in the pipeline, being discussed, or already partly implemented. So finally, to conclude, how do I personally look back at what we've done? Did we go wrong? If so, where? Obviously, it's early days. I think one has to be humble about this. I would never want to give a sort of definite conclusion at this stage. I have to say, as I gain a bit more distance from it, as I look at it also back with a private sector perspective, the one question that troubles me more and more on a personal level is that should we have simply gone philosophically down a different alley by saying we need to be more ambitious, much more radical on capital, and essentially step away from everything else, in the hope, sort of almost it's a philosophical discussion, in the hope that if you're ambitious enough on capital, the price mechanisms, the price incentives of capital requirements would work in a sort of mysterious way, in an invisible hand way almost, to create such strong incentives in the banks that in the end we would have the outcome that we were hoping for, aiming for perhaps, and essentially trying to create later on through all kinds of structural mechanisms. So in other words, to put it very simply, it's a hypothesis. Should we have been much more ambitious, more resolute on capital, and in return not gotten involved in all the various structural discussions where, to some extent, we put ourselves in the position of management and boards and have faith that the price mechanism of capital would work in a way that we would get the desirable outcome in the end. We can't make too much out of one example. And we in Switzerland actually also kind of went a double route, much like John, where we had a very strong capital piece, which has gotten a lot of attention internationally, but we actually also had some structural measures. When I now look at what's happening in UBS, which to me is probably the beginning of what we're going to see much more broadly in many other banks, it is plausible, I think, to argue that what is driving that, apart from some idiosyncratic sort of developments within UBS, the main driver of that is an ambitious capital plan. And perhaps had we been globally more simple in our approach and more ambitious on capital, we might have gotten, or we might be getting, better outcomes on the structural side. So it's a hypothesis at this stage, but it's something that preoccupies me more and more as I try to reflect back on what we've done based on the evidence of what has happened so far in terms of the actual effect and the developments in these banks. Thank you, John.
Thank you, and certainly that accords with my understanding of the great convulsions that are going on at UBS. It's driven more than anything else by capital requirements, by the need for a new capital plan. Could we now move on as we continue our move around this very high-powered panel to Adair Turner, who has to run the Financial Services Authority here in the UK. Again, the question remains, have you let the banks get away with this? Is there anything that you have not done that you wish you had done?
Well, let me end up with that point.
Sure.
But I'd like to begin by sort of repeating some of the things that John and Philipp have said and go back to the basic theory. But I will get back to that point clearly, and I think I'll end up in a very similar space to Philipp. Banks are highly leveraged, limited liability companies. And that is a very specific feature with some very specific consequences. Limited liability companies emerge in the 19th century, and they are a specific legal structure with a specific set of advantages and disadvantages. They essentially give to the equity owners of a company what is effectively a sort of put option. They enjoy the upside of profit, but if the losses go beyond a certain point, the equity owners do not have to put in money. And there are a good set of arguments why the creation of limited liability companies is one of a set of institutional innovations of the 19th century which are important to the creation, first of all, of the first industrial revolution here in the UK, and to the general development of market economies and their efficiencies and benefits throughout the world. But when you combine that with very high leverage, you've got a very specific institution, because you are really maximizing the value of the put option. When you are the manager or director of a bank, you can have huge upside from this highly leveraged play on profit, but you have the ability to walk away if it goes down. Now, what is interesting is that many economists have then hankered after getting rid completely of either that highly leveraged element or of that limited liability element. So various economists, I mean, Charles Goodhart occasionally has mused on, are banks the one institution to which we should not have allowed limited liability? And actually, if you go back to the 19th century, for a long time we didn't allow limited liability for banks. We forced banks to be partnerships because we said this is too dangerous to extend limited liability to banks. Now, I don't think that that is actually credible. I do think we need large banks, and I don't think you're going to have competent directors of them with limited liability. But you need that as a provocation. The other great provocation from economic thought is the provocation of people like Henry Simons and Irving Fisher, early Chicago school proponents, who were in the wreckage of the post-29 collapse of the banking system in the US, said, why do we need these highly leveraged institutions? Why do we need fractional reserve banks at all? And so both Henry Simons and Irving Fisher in an article called 100% Money Banks, said, you know, we shouldn't have all these debt instruments out there. What banks ought to do is take your money and provide a convenient way of payment services, but they oughtn't to be in the business of lending out at all. Lending instruments should be completely different, separate securities which don't go through the banking systems. Again, when I've looked at this issue, I don't think we can go that far, even in an ideal world, let alone in a transition from where we are at the moment. But I think both of those thoughts are a real provocation for us to realise that the situation that we ended up with by the end of the crisis with these highly leveraged institutions doesn't need to be. There is nothing in economic theory that says that in order to run an efficient modern economy, we need institutions remotely as highly leveraged as those that we've ended up with. And just understand how highly leveraged these are or were before the crisis, and then I'll come back later to how far we've managed to get away from it. Before the crisis, Basel II said you've got to have 8% total capital. Of that, at least half has to be what's called Tier 1. Of that, at least half has to be core Tier 1, which is equity. So you've got to have 2% equity. But Basel II also said you can model your own risk weights. And some of the risk weights come along and say, well, I've looked at the risk weight of this trading portfolio or of this prime mortgage portfolio, and I believe I should only apply a risk weight of 10%. And provided they've got models, we the regulators say, oh, yes, you've got that. Now, if you have a 10% risk-weighted mortgage portfolio and a 2% requirement against risk-weighted assets, that means that you can run a mortgage bank in which you lend £100, finance 99.8% by debt and 0.2% by equity. Now, when you tell the ordinary person who knows nothing about banking this, that this is what we're doing, they think this is certifiably mad. And I think it is very close to certifiably mad. And I think we have to wonder how on earth, what was the process by which over many years, and I sort of partially agree with John that it was in the 10 years before the crisis, but actually I think this was going on for about 50 years, that we were allowing a steady growth in the leverage of the banking system and not quite realizing what we were doing about it. So I think there is a very strong argument, which has been put forward by people like Martin Hellweg and David Miles, that if we were starting anew, if we were benevolent dictators of a greenfield economy, we would have bank capital ratios which are not just those to which Philipp and I, in a process of trench warfare with some of our opponents about the world, managed to drag up to the Basel III levels. I think we'd have much higher level. I mean, you know, David Miles has argued that optimal capital ratios should certainly be something like 20 or 25% against risk-weighted assets, arguably higher, so has Martin Hellweg. And I think we have to realize that unless we go there, we will still have highly leveraged institutions which, when they go down, will have a danger of imposing losses potentially on taxpayers to bail them out, and certainly on the economy. Because when these machines go down, in the upswing they provide excessive credit to the economies. When they break and fail, they produce a credit crunch, and that produces enormous macroeconomic volatility. Now, you might say, but why is that? Why can't they just go down and we'll impose losses on the debt holders? Because beyond the equity holders, there's the debt holders. Why isn't it as easy as that? Why don't you just impose losses on the debt holders? Well, there are two problems. One is the application, and John mentioned this, of bankruptcy or intelligent insolvency procedures to a banking environment. What an intelligent insolvency procedure does, it doesn't close a company and hold a fire sale the next day. It tries to get maximum value from the assets. And what intelligent insolvency or bankruptcy procedures like Chapter 11 in the US do is essentially draw a distinction between the financing of a company and the operations of a company. It says, I want to go on continuing to pay suppliers and continuing to pay workers and keeping the franchise of the business going, but I want to take all the finance, equity or debt, put it into a sort of separate little folder, tell them you may get nothing, you may get something at the end, we've yet got to work that out. You separate it. When you come along to a bank and try to apply normal bankruptcy procedures, you have a problem. Well, what is the finance and what are the customers? You know, because the business of this business is money. The business is taking deposits. The business is doing trading deals. You don't have that nice clean separation between that which is finance and that which is operations. But the second problem you have is that even if you get down to the financial layer, and you say these guys have issued debt instruments. I think there's something fundamental about debt that we've got to think about in our macroeconomy. André Schleifer has, with various colleagues, produced some great articles about the nature of debt instruments. And he has this very interesting concept called local thinking. There's something about a debt instrument that when you've received it, although it has a probability distribution of payouts, which has a frequency distribution to it, in the good times, you assume that the only possible payout is 100% of the precise face value. Whereas when you own an equity, you know all the time that there are ups and downs. You know that there is a probability distribution of payouts. And the local thinking concept is that in the good times, a whole load of people have invested in debt instruments, whether they be the debt instruments of banks or of other institutions, and they have fallen into the assumption that they have risk-free instruments, and they have structured their own balance sheets, their own activities on that assumption. And if you then come along and impose a loss, you will impose a shock to the economy. And that's why there are a whole load of economic impacts to bankruptcy and to debt, and why I believe sitting behind the whole of this banking crisis is an even more fundamental issue about whether we have allowed our entire economies to become over-leveraged with too many debt instruments, and whether we have to build a less leveraged economy for the future. But it does mean that in the arena of banks, if you simply say, even in relation to the debt instruments, the clear debt instruments rather than deposits, okay, I'm going to let those go down. If you literally do that, you may end up shocking the economy. You may end up producing a completely financial crisis, which is worse in its effect than having to put a taxpayer bailout. And having lived through, as Philipp lived through, September, October 2008, I can tell you, yes, we did think about whether we should impose losses on the subordinated debt or senior debt providers of RBS and HBOS. But we were terrified. We were terrified that if we imposed those losses, those instruments were held by other financial institutions, and we would just be tipping over a domino, and we didn't know where the rest of this domino set was going. And that's where you then get to the debate about bail-inable debt. Bail-inable debt is contingent equity. The best response to all this would be to have so much equity in banks that we reduce the probability of failure to a very low level. And again, I somewhat hanker with Philipp after doing that and then saying we can get out of a lot of the detailed supervision because there'll be such large equity buffers that we're confident that if management screws up, the only people who suffer are the equity investors, and it's their business to monitor banks. But suppose we can't have enough equity to get to that position. We play around with the concept of bail-inable debt. Bail-inable debt is contingent equity. It's stuff that turns into equity when we need it so that we can resolve companies, banks, without taxpayer support. I think it is a good idea, but the one thing I would say, which I think is a missing point of our debates, which we haven't focused enough on bail-inable debt, for it to work, you've absolutely got to be confident in October 2008 that you can press that button without causing more problems even than a bit of taxpayer support. That will only be true if bail-inable debt is beyond a certain tenor, maturity, term, because then it can't run and be a self-fulfilling form of crisis. If it is unsecured, because then that's the only way you'll have a clear form of bail-in. But crucially, and I think this is the bit that we haven't debated enough, if it is held pretty much entirely outside the banking system, essentially by non-leveraged end investors, who are therefore in the position of quasi-equity holders and whom we will be willing to impose losses on and be completely happy about that. So finally, if that's what we need to do, ideally lots of equity, second best contingent equity, what have we done? Did we not do enough? Well, first of all, I would say we have done a lot on equity ratios. And maybe I'm bound to feel that because I said Philipp and I spent many days in windowless rooms in Basel and elsewhere in the world fighting for a better equity regime. And people say, well, it's not enough, and in an ideal world, I'd do more. But it is a big change. We changed the numerator, the definition of what is equity capital. In some crucial ways, particularly in the trading book, we changed the denominator, the definition of risk-weighted equities. And we required higher ratios, so that the absolute limit ratio for what we call a globally systemically important firm basically goes from 2% to 9.5%. You take the numerator, the denominator, and the ratio, and I guess that we've increased the absolute minimum amount of capital that the Goldman Sachs and the equity, Goldman Sachs or HSBC or Barclays have to hold by 7 or 8 times, and that's not bad. Maybe it should have been 20 times, but, you know, we did something. Why didn't we do more? Well, partly because we reside in an arena of lobbying. There is lobbying. Partly because there are different points of view from different regulators across the world at the appropriate way forward, but also because there is a major problem in fixing an overly leveraged financial system, which is, you know that on a greenfield site, as a benevolent dictator, you want to go to a much less leveraged banking system and a much less leveraged economy, but try getting there quickly without making the post-crisis transition even worse. The process of deleveraging after financial excess is an immensely difficult transition, and I think we are only slowly waking up over the last 3 years about how incredibly difficult it is when we're trying to do it simultaneously in all 4 major economic blocs in the US and the UK, the Eurozone, and Japan. And so partly we did deliberately aim off the level of equity increase that we would have wanted, because we were aware that if we got that wrong, we could slow the economy even more than it is slowed already. But nevertheless, we are having an impact. If you look at what UBS has done in relation to its new plans for its investment bank and a very major scaling back of trading activity, which I once notoriously described as socially useless and which I continue to describe as socially useless, the reason why they've done that has a hell of a lot to do with the increases in trading book capital that we have imposed. So I think we have had an impact. I think we've done as good as you can get in an imperfect world. That is my defense. Thank you.
I'm glad to hear that. Just one interesting point on where the limited liability banking was a realistic option. Goldman Sachs, of all people, was a partnership until 1999. It's a very recent for to have penetrated in the investment banking sector to have moved on to the equity process. Now, can I move on to our final panelist, Professor Colin Mayer from the Saïd Business School? Again, the question is whether whether we have seen a big escape here, whether more has been whether more needs to be done, and also what is it that can still be done that has not yet been done?
Okay, thank you. Well, I'm in the position, possibly fortunate position, that I don't run a bank and I don't regulate a bank, and since I don't do anything or stop anything, I can talk a lot. But fortunately for you, I won't talk too much. I think it's worthwhile just putting this in context, that basically what's happened over the last few years is that we've moved from a position of regulation being naive to being negligent to being confused. And it started off from a position where there was a view that said that basically financial institutions, financial markets were like car producers and markets for tomatoes. Encouraging more competition, deregulating were good things. Basically, all that we needed to do to ensure the efficient functioning of financial markets was to make sure that they were transparent and that there was good information in those markets. And then post the crisis, the shock that came from that, first of all gave rise to a reaction that said, these are outrageous banks, they're being thoroughly mismanaged, and what we need to do is to improve the way in which those banks are managed. We need to improve the governance, we need to make sure that people are more fit and proper for running those banks, and we need to make them more accountable to their owners. And that initially had the effect of actually potentially pushing the financial system in exactly the wrong direction. Because by encouraging banks to have similar structures essentially what the regulatory system was doing was to introduce a greater degree of uniformity that actually was potentially a source of financial instability. And so the effect of essentially encouraging financial institutions to reform on their governance side was to promote the activities that in large part were associated with poor financial performance during the financial crisis. So ironically, a lot of the financial institutions that performed the worst in the financial crisis were the ones that in principle had the best governance structures. And it's not terribly hard to see why that might be the case. And it comes back to something that Adair was talking about just now. And that is that if you essentially have banks that are extremely highly levered and you encourage them to become more focused on the behavior of their shareholders, they'll do that. And they'll do that basically by playing on the put option that they gain from the upside and they don't take the downside loss. And that is precisely what we observed, and that was basically a fundamental underlying problem of the financial crisis, the divergence of interest between shareholders and creditors, and by strengthening governance, you effectively make things worse, not better. And then the view moved away from saying, well, it's all a problem associated with individual financial institutions, to a realization that actually the problem was systemic in nature, not individual institution in nature. And then we have three sets of developments that take place. A lot of what has already been talked about in terms of capital, cushions, buffers, etc. Critically important, I agree with all of the views that were said by Philipp and by Adair, that we actually need more of this, not less than is currently being proposed. But it is important to understand that there's a serious problem of irreversibility. It's a bit like youth. Once lost, it's terribly difficult to retrieve. And likewise, capital. Once lost, it's very difficult to bring back. And why is it difficult to bring back? Because there's a simple problem which comes back to the one that I was mentioning earlier on. It's called the debt overhang problem. Okay? If you've got a lot of debt and you encourage institutions to issue more equity, a lot of the benefits accrue to the creditors, not to the shareholders. So essentially, they're giving things to the creditors. And that makes equity very expensive. It's not socially expensive, but it's privately expensive for the providers of that equity capital. And as a consequence, banks have an alternative to putting up that equity. They can say, right, we're simply just going to stop lending, stop engaging in risky activities. And there is a view that's going round that's saying, actually, quite a lot of the problems that we now are facing in terms of the inertia of lending in banking is due to banks reacting in exactly that way of saying, it's too expensive, privately expensive for us to raise equity. It's cheaper for us simply to withdraw in terms of the degree of risky lending. And so that then leads to thought of, well, how can one overcome that essentially wealth transfer problem? And that's where bail-inable debt comes in, because essentially what one then should try to do is to say, well, one needs to convert some of the debt into equity, and at least one should do that during periods of financial crisis, and bail-inable debt has the attraction that it essentially avoids that debt overhang problem, at least to some extent. So bail-inable debt is potentially a very important component of the provision of adequate liquidity and cushions to the financial system. And that then comes to the third element, which is, well, what happens when they actually get into crisis and resolving failing banks? And the notion that Adair was saying that one has to support all forms of debt, bondholders as well as depositors, has clearly proven to be unsustainable. The reasons for it were quite clearly set out. There was a concern about what were the ramifications of not bailing out all debt. But one thing we now realize is we simply cannot afford to do that when any financial crisis occurs in the future. We need more subtle ways of being able to resolve the financial system when those crises occur. And that then comes on to the final area which John was talking about in terms of structural reforms, the ideas of essentially separating or ring-fencing different parts of the financial system, and the various proposals that Erkki Liikanen, John has put forward, Paul Volcker, etc. Now, those don't just differ in terms of detail. There are some really quite significant differences in terms of views that lie behind those various proposals. And I think a critical question, this is the main point which really comes back to the opening question about whether or not banks have got away with it. The critical question that I think it raises is, well, why are we doing this? What are we trying to achieve? Now, the answer to it is, obviously, we're not just trying to make the financial system safe. It's a bit like saying, how do you stop planes from crashing? The answer is, you don't let them fly. Well, we can make the financial system perfectly safe, and indicated one way in which you can do it. The discussion about narrow banking, you just require banks to put all of their money into safe assets. But the real question is, what do we want the financial system to do? What do we want our banks to do? And that's really been the missing question in the whole of this debate. And if we bring it back to the previous session, that session was about, well, how do we get the financial system to promote economic growth? And the whole of this, this conference is about promotion of economic activity. And it raises a question, do we want our banks to be essentially concerned with the payment system? Well, one of the interesting things that's going on in some developing countries is that payments is basically happening outside of the banking system through mobile banking. It may not be needed for that. You know, that may deal with quite a lot of the systemic concerns that people have got. We clearly want banks to promote the development of entrepreneurial small companies and medium-sized enterprises. We want them, as was discussed at great length in the last session, to promote infrastructure investment. But we also want to be able to use the capital markets to allow companies to come to the stock markets, to be able to raise money on those markets. We want the financial institutions to be able to hedge some of the risks. Do we want them to diminish the risks of the pension funds as well? Clearly we do in a system like the UK, where pension funds are such a critical part of our financial system. And that makes defining more precisely what is the critical part that you want to put inside the fence and protect from the lions, and leave outside the basic question that one needs to think about before one thinks about erecting those barriers. And I think we've actually failed to learn quite a lot of lessons, both from across countries, but also from history. Because as I was mentioning earlier on, one of the problems that has been put forward is that the regulation should be basically harmonized across countries. Now, the great saving grace of the financial crisis is that it was not a global crisis. It was a crisis that basically afflicted some European countries and the US. It didn't even afflict Canada, and it didn't afflict most parts of the rest of the world. And it's particularly interesting learning from countries that are rather similar to ours, like Australia and Canada, as to why their financial systems were not afflicted in this way. And one of the reasons is that their banking systems were actually pretty concentrated in both cases. And they were able, through having a relatively concentrated banking system, first of all, to ensure that there was a significant charter value to having a license as a bank. Secondly, to ensure that the capital adequacy of those banks was sufficient and to regulate them much more tightly than was the case in other parts of the world. The lesson from history is that for 100 years, from 1998, or more than 100 years, to 2008, we didn't have a financial failure in Britain. And that was despite the fact that we've never had any separation between commercial and investment banking. Again, it was largely due to the fact for most of that period we had a highly concentrated banking system. And so that really raises a question as to whether or not we've actually focused on the right set of policies. And I'd just like to come back to Adair's point about the issue of limited liability, and should we eliminate limited liability? That seems to me to be an obviously wrong approach to take. On the other hand, the fundamental problem that I was just describing to you was a conflict between creditors and shareholders. And as Adair was saying, it's bizarre if you've got an institution that is 99 point something or other financed by debt, that the sole or primary responsibility of those running the banks is to the 0.2%. That is a real problem for an institution like that. And so the question about, well, what should be the fiduciary responsibility of directors? Should it be essentially just to the shareholders, or should it be more broadly defined to the investors in the bank as a whole, including the creditors, is, I think, an important one. And one might even go further than that to say, well, the interesting feature of a bank is it's a double-sided institution. It's important in terms of its assets as well as its liabilities, namely its loans as well as the deposits. So perhaps the fiduciary responsibility ought to be not just to creditors, but to the debtors of the bank as well. So I would suggest that the problem that we've had is that we've started from a position which was very naive about the nature of the financial market and financial institutions. We then moved to a position where we were basically being negligent in not taking account of the impact of the changes that were being introduced. And we've ended up in a position where we're very confused about what we're trying to do, because basically we haven't asked the right questions about what fundamentally are we trying to get our financial institutions to do, and how should we achieve that? And should it be better done through essentially giving licenses and charters that have defined purposes, which specify exactly what, from a social as well as a private point of view, we want our banks to do, make sure they're well capitalized, make sure that they have fiduciary responsibilities of their directors that are appropriate, and that they have adequate capital, including bail-inable debt, etc. So ensuring that there is at least a part of our financial system that we can really trust. And since I don't do anything, I think I at least should stop at this point.
I think you should stop just because you've raised some very, very interesting questions to pass on to the rest of the panel. I think it's fair to say that there was a certain consensus that in many ways, rather than structure, which tends to dominate many of these discussions, the problem was leverage writ large, and that structural issues in many ways were an offshoot or could be dealt through the essential problem of dealing with leverage. Is there? Yes, exactly. What interesting, we've barely heard about the Volcker rule, which is the US position that commercial banks should be separated from proprietary trading, hedge fund-like activities and private equity, and we've not heard at all the mention of Glass-Steagall, which was the rule which held in the US until just over a decade ago, that there was a complete split between deposit-taking banking and investment banking and insurance. Now, are there good arguments that such strong and brutal or brutish structural remedies aren't needed? Would you like to go first, John, with that?
No, I think structural reform is part of the smart package. And I mean, I agree with everything that's been said about leverage and capital, but as a practical matter, we are not in. We're not going to get to that point, and of superabundant capital. And even if we did, it's not clear to me that structural reform would be off the table as part of the optimal policy mix. I think there are incredibly powerful reasons for that. It plays into the resolution debate, which Philipp touched on. It plays into the insulation of going back to all Colin's points about what are these banking services for. Nothing is perfect, but it gives other layers of insulation, structural layers of insulation from some kinds of shock for these absolutely core banking services whose continuous provision, not continuity of the entities necessarily, but continuous provision of those services is absolutely vital. Now on Volcker, I think there's a big danger about the Volcker debate in Europe. When it became clear in the UK that the government was up for doing some structural reform, the banks, in their hearings with us, suddenly got religion and said, well, you should do Volcker, because that had the least impact on them of all the structural reforms on the table. Because if you take the slice out of what is proprietary trading, that is massively less than what we thought should be ring-fenced away from retail. So although it's portrayed, and I think it suits lots of interest to portray Volcker as the really tough thing, it's actually the opposite in a European context, taking other things as given. It's also proving extraordinarily difficult to implement in the US. And I know Liikanen, that group, looked very closely at Volcker because, for example, some of the French banks are urging Volcker, I suspect for the same reason that I've just alluded to. And Liikanen was, explicitly against that. Don't try and draw a line through different kinds of trading, market making, and all the rest. The other extremely important thing to realize about Volcker is that Volcker in the US is on top of lots of other regulation. There are, you're right about the repeal of the Glass-Steagall total separation provisions, but there are surviving provisions of the 1933 Banking Act, the Glass-Steagall Act, which are something at least akin to a sort of ring fencing. They don't say the deposit taker can't be affiliated to the securities dealer and all the rest. They say, following the 99 repeal of those provisions, you can be affiliated, but there has to be this kind of separation. You have to deal on these terms. There's Section 23AB of the Federal Reserve Act. There's Regulation W implementing that. There's things in Dodd-Frank. So it's just a complete misconception of the debate to think Europe or the UK, a country in Europe, should just do Volcker, because it doesn't have that surrounding apparatus. A much better question is whether you should add Volcker to the kind of proposals which we came forward with, or add Volcker to Liikanen. I would say not, but that at least seems to me a sensible question, unlike the way it's quite often cast.
Could I just ask you, what if we make the choice between something like full Glass-Steagall or the ring fencing that you came up with? What are the positive arguments for ring fencing?
Now that debate, that debate goes on in many fora. One of the most interesting is the Parliamentary Commission on Banking Standards, which has been running through the autumn, looking at the standards issues in the wake of the scandals and also the pre-legislative scrutiny of the banking reform bill here in the UK. And there are people like Nigel Lawson, Lord Lawson, and the incredibly impressive next Archbishop of Canterbury, who is really hot. I mean, all the acronyms. He's absolutely great, at least on all these issues, I'm sure more generally. Yes, I am not going to go there. Not going to go there.
We're not now, that leap of faith.
Nigel Lawson would disagree with the proposition that historically we did not have a separation between commercial banking and wholesale investment banking in the UK. He would say de facto we did. And it was only really in the late 90s that the high street banks started to get big time into all these other activities. Now, I think the full split debate has got into, in some ways, a bad place. It's as though ring fencing is half-hearted full splitting. That is not the case. A huge problem that the full splitters face is the one that Colin alluded to, which is if you ended up with a completely standalone, undiversified, highly correlated British retail banking sector, that would create lots of financial stability risks, and you don't have recourse to resources elsewhere in the group. Now, if you took the view that, well, it's utility and consumer and casino, there are no risks in retail banking, then it might be a coherent position. But it's obviously false. Look at the Spanish Cajas, look at the Irish banks, look at Northern Rock, etc., etc. So the reason we didn't go for full splitting wasn't just a sort of compromise, oh, it's the art of the possible. It was that it's much higher cost and you're creating a financial stability risk of one kind while you're trying to cure one of another. So that's what I would say on that point. Later on, I'd like to say something, given at the Blavatnik School, about the relationship between academics and this debate. But can I put down a marker for 2 minutes on that later and shut up for now?
No. Can I pass that question on to the gentleman on this side? When it comes to structure, are there arguments for structural reforms for the sake of structural reforms rather than as the byproducts of reforms to leverage? Who, Philip? Yeah.
So, I just want to make it clear. I am convinced that structural change is part of what has to happen. So in that sense, I wholeheartedly agree with John that it is part of what I would call a smart outcome. The question is, what are the most likely drivers that will generate that outcome? And what I worry from a very practical point of view, as you look at these structural initiatives and ideas that are circulating and being implemented or being discussed, I think they have a huge danger embedded in them, that they will diverge greatly from nation to nation for all kinds of reasons that have to do with they're detailed, they go into, in many ways, into political arenas, they depend on history, on the banking model as it was before the crisis, etc. So there's a whole host of reasons why it seems to me these initiatives will tend to increase our problem of diverging trends across the major financial centers. So that's one sort of practical problem, and you can see that, it seems to me, fairly clearly in the various debates, whether it's Europe versus UK versus Switzerland versus Volcker, that if you project this forward another 5 years, it's quite likely that we're going to have a hodgepodge of sort of rules in these major financial centers. And then the second question is what will generate the most sort of productive outcome in terms of structural change? And UBS is a very interesting case study. Because actually, if you look at what's happening, and I suspect it will not be the last case, it's probably the first of many to come, and perhaps it'll go even further. But the evidence seems to suggest that the one case where we're really getting significant structural change has actually not been driven by significant structural rules or structural reforms. Now, I don't want to totally ignore here that in the Swiss regulatory response there is a structural piece, but the way I read what's happening at UBS is that the measures that have been announced and now need to be implemented, that's a caveat, but the measures that have been announced at UBS have little to do with any of the structural requirements that were put into the Swiss law, but are almost entirely driven by the current capital requirement and perhaps by the chairman's anticipation of what might yet be in the pipeline on the capital side. So my point is simply a very practical one. I think we all agree that structural change is necessary to get to a banking landscape that makes more sense based on all the issues we heard today. And the question would be, from a practical perspective, what dynamic gets us there in the most efficient way, while preserving as much as possible a sort of level playing field. On the Volcker rule, just maybe one anecdote. So when this first came up, I remember I called Paul Volcker and said, you know, how are you going to distinguish between prop trading and flow trading from the outside? The banks themselves can't even distinguish it inside the bank. How are we as regulators going to distinguish that from the outside? And his answer was classic Paul Volcker. He said, somebody smart will figure it out. But you know, the truth is, we really haven't figured that out. And if you look at the practical rules implementation of the Volcker rule, it's unbelievably complicated. There are, I believe, John, over 100 rules already now that are being drafted or have been drafted. Even in the asset management industry, we now see a whole bunch of these Volcker implementation rules that impact all kinds of areas of the business. I think that the fact is, you know, to implement the basic idea, which again was a very sensible idea, turns out to be incredibly complex and incredibly difficult. So it's a bit the same problem, right? We agree that the structural change embedded in the Volcker rule makes a lot of sense. The question is, how do you get it implemented in an efficient way that doesn't undermine the objective of maintaining an integrated global financial system and as level a playing field as possible?
And your argument is that that's by the invisible hands that start to work once you put a much more stringent leverage requirement on them, rather than by
I'm not sure it's a fully formulated argument yet. What I tried to convey to you is, as I begin to reflect back on what we've done, it is a thought that keeps coming back and to me and preoccupies me, whether there is a more efficient mechanism to get those changes done. Now, if John is right and says, you know, yes, perhaps, but we'll never get to the capital levels that would be required to trigger that change, then of course, you know, we're in a different world again. But the UBS case to me is a very interesting case, because we are seeing now the most radical structural change so far, presumably, or arguably, in these very large banks. And it really has very little to do with structural reform.
Well, I could just do a sort of two-hander on a couple of points. First of all, I don't think the UK and the Liikanen things are very different. And the biggest difference is securities underwriting, where, in my view, the UK is clearly right and Liikanen's clearly wrong. That we could, and Liikanen's very ironic, given Glass-Steagall. It's precisely the other way around. But the point I wanted to make, Philip, is I think the moves towards ring fencing have been getting some of the private sector juices flowing in the direction of structural separation as well. I think the key thing is to get the perception that the taxpayer is off the hook for investment banking losses. Right. And that can be done. I think you need a complementary strategy. I think that higher capital requirements and trading book things are essential for that. But I also think that the ring fencing, although nothing is perfect in life, I think that really helps in an additional and reinforcing way.
Well, it's the taxpayer and the depositor, isn't it?
And the depositor, and that's why I don't want to go into it, but that's why I mentioned depositor preference for insured deposits. Right. I think that, and that is also very important, breaking some of the pari passu things in bail-in, and these principles about no worse off than bankruptcy. This depositor preference piece, it's not very sexy, but I think it's very important.
Okay. Well, like Philip, you know, when the Volcker rule came out, I called Paul Volcker and said, absolutely agree with you. You know, but this is very technically difficult. How are you going to do it? And Paul said, Adair, I was hoping you're going to tell me that. So, but I actually wanted to pick up some points that Colin made, that within this whole debate, I do think we need to keep returning to what do we want banking systems to do and what do bank systems to do, and therefore make sure we focused on the most important things. And then I am a supporter of the ring fencing which John's commission came up with. I think sometimes in that ring fencing debate there is an over-focus on saying that the really important things that you have to protect are the payment system and deposit taking. I actually don't think this is where our problems are. I mean, basically, we could run the payment system as a standardized utility completely separate from credit-providing banks. And I think in pretty much most states of the world, we know how to make sure that the payment system keeps going. You know, the issues about do you impose losses on debt holders or not debt holders? You know, they don't fundamentally change our ability in some way or other to keep the payment system going. And when you go to deposit taking, at least for retail deposits of 95% of the population, I think we sometimes don't honestly face the fact that we have socialized that risk. I mean, up to 85,000 per person, up to 170,000 per joint account is covered by deposit insurance, which de facto is underpinned by the taxpayer. I mean, let's be clear, if the FSCS, our deposit insurance, runs out of money, we're going to do that. And that's why, on the whole, now that we've got a sensible deposit insurance system, which we didn't at the time of Northern Rock, because remember, only £2,000 was 100% insured, I think we're very unlikely to see retail runs in future, because as long as people understand it, and let's remember, you know, the vast majority of people don't have more than £85,000 sitting in a bank account. And in the US, it's now $250,000. You know, post-crisis, we have largely socialized the risk of retail deposits. What really matters in the banking system is the machine of credit supply. And the way that if we wrongly regulate banks, and this is why we need a systemic focus, we will end up with surges of credit supply and then dearths of credit supply. That's what's really, you know, caused harm. Even taxpayer bailout, the total is not all that big. The total cost of overt taxpayer bailout of the UK government's equity injections to HBOS LBG and RBS and Northern Rock and Bradford and Bingley, right, will end up costing the UK taxpayer absolutely max £50 billion, which is less than 0.5% of GDP. While the macroeconomic cyclicality induced by this out-of-control financial system will produce a 2015 GDP 10 to 15% below the trend that we were on, and will produce a cumulative aggregate loss of GDP, which will be 50% or so, 100 times the overt taxpayer loss. So we have to focus on the really, really important thing, which is the credit cycle. And then within that, I think Colin said, you know, we really have to focus on what the banks do. And we often tell this story that what banks fundamentally do on the credit side is that they take savings from people and they invest it in productive assets. Well, that's actually a small part of the credit intermediation process in the UK. Our banks, sterling lending by UK banks in the UK is about 1.8 trillion, 1,800 billion. Let's break that down to what that is. About 150 million is unsecured personal credit. That's nothing to do with funding credit to productive investment. That is fundamentally a way of structuring a contract between patient and impatient people, right? About 1,200 billion is mortgage finance. Now, in some countries, mortgage finance is a lot to do with the process of building new houses. Actually, the extraordinary thing about Britain is we managed to have extraordinary house price booms and still not build many new houses. Broadly speaking, our mortgage finance is about providing money for the purchase of existing assets. And it is fundamentally life cycle consumption smoothing, right? It is people who have, you know, at aggregate terms, older people selling assets to younger people. Now, that can be welfare enhancing, but we have to understand what it is. It's nothing to do with this story we typically tell us about, you know, allocating credit to productive projects in the economy. So then we're left with, you know, 450, 500 billion of corporate lending, of which 150 billion, I would say, is essentially leveraged investment plays on already existing commercial real estate assets. And then maybe 50 billion is new commercial real estate investment, and then about 100 to 200 million is actually non-commercial real estate corporate lending. So about 10, 12% of what our banking system does is what we often describe it as doing. And I think it's very important for us to know that, to have sort of sanity in our debates here. Now, I'm not knocking mortgage lending. You know, life cycle consumption smoothing can be a welfare-enhancing role of a banking system, but we need to know that's what it is. And the point that I then want to link it to, just the only point I want to make on ring fencing is, John came up with his proposal on ring fencing and allowed a degree of latitude as to what was inside the ring fence and outside. And the bit that you insisted was inside the ring fence was deposit taking, and I agree with that. We in the FSA, and I personally, very strongly believe that SME lending should be in there as well, because I think this is the thing which is not easily substitutable. Large corporate lending is to a degree substitutable by the corporate bond markets, and the corporate bond markets are capable of doing credit analysis for large corporates. But it is small corporates where there is a socially vital function of credit analysis which is best done sometimes when it is actually linked with the payment system, because you can do credit analysis if you've also got the current account and you can understand how that business is going, and is certainly best done in a decentralized branch network which is close to the end SME customers. So I think ring fencing is right, but I think if we're going to have ring fence retail banks, I definitely think we should put SME lending within it, because when I think about the vitally important functions which are not performable outside, and which, if we don't get them right, will be provided in over easy credit terms in the upswing, and then by a credit crunch in the downswing, I would say SME lending is one of the most important of those.
Great, thank you for that. I've been extremely remiss in my time management. So let us move to this point you wanted to make about the relationship of academics to to the...
So this is going to sound a self-pitying anecdote, but it makes the... I was at a conference in Brussels where it was like this, but there was a much bigger display thing behind us and about 50 bank logos on it. There was a panel of 10 people, 5 bankers, a couple of members of the European Parliament, 2 regulators, and me. Because those regulators felt hidebound by convention, they were nothing like as outspoken as Adair has been today and is generally, as Philipp has been on various occasions. And it turned out I was the only one making any serious case for reform. And I got severely attacked because I was only given 1/10 of the time. But my worry about, or my issue about how academics play into this is that if the academic contribution is people saying, no, you should end fractional reserve banking, or we should have a huge 10-year timeout while we think what the purpose of financial services is, or whatever, then the vested interests are just going to run away with this. So my plea, and this seems an appropriate place to make it, is that while that's all fine and helpful and fruitful, there is a real risk of completely all over the place academic discussion versus concerted effort by the vested interests. And then the answer to your great escape question would be, yes, there is the great escape.
Right. In terms of, we need to make enough... Yes. Yeah.
I mean, the way I would put that is, we need academia to help us understand what is the best, but don't make the best the enemy of the good. And I think that's really important. You know, we, Philipp and I, and John in the Commission, have worked in the environment of understanding, you know, the literature and the arguments about what we do in an ideal world, and then trying to work out, okay, what are we going to do in the world that actually exists? And that's what I think you have to judge us against.
As I never brought you back in, please.
No, I think that the point that's just been made about the impracticality of a lot of academic research is a critically important one. And I think one of the real failings that's occurred, in particular in the UK and in Europe, is that academics have not engaged in the policy debates. And it's very different actually from the US, where there is a much more engagement by academics over there. And I think that British academia and European academia more generally needs to get its hands dirty and to really participate in these debates actively.
Well, we seem to have done that so far today. I fear we really only scratched the surface of a very important subject, but what we scratched
is very interesting. Final point I'd like to make is it's a delight to talk about this subject for an hour and a half and never once mention or allude to the topic of remuneration for bankers, which I can assure you accounts for more than all other aspects of regulation put together in my email inbox at the FT. Thank you very much indeed. It's been a pleasure. Sorry you overran.